The Bible says, be not deceived. Whatsoever a man soweth, that shall he also reap.
All right, it's 4 p.m. on Wall Street. Do you know where your money is?
Welcome to Financial Issues, where we align reality with truth. Conservative talk radio you can count on. Financial issues that you need to know.
We face a disintegrating economy, a weakened defense, and an energy policy based on the sharing of scarcity. We will simply apply to government the common sense that we all use in our daily lives.
Now, here's your host, Dan Celia.
Issues. I'm Dan Celia. It's Friday. That means it's Rapid Fire Friday. Rapid Fire Friday works like this. If you don't know how it works, if you're new to the program, welcome. But what we do every Friday is we go through the news, or not the news, I'm sorry. We go through your questions as quickly as we possibly can. So we get to calls early and we stay with them. Our goal is to take as many calls as we possibly can and answer as many questions. But we need your help. We need you to get right to the point and make your comment or ask your question. And then I will comment on it as quickly as I can. Sometimes that's difficult because of the nature of the question, but I'll try to do my best. And then we move on to the next question. So it's rapid fire. We try to rapid fire through the questions as quickly as possible. Our phone lines are open. If you call in now, you're going to be the first one to go on the air because all the lines are open, 866-300-9298. Now, we've had a full board for 2 weeks, so I suspect that we will again today. But right now, the whole board is open, 866-300-9298. We'll go through some economic news, then we're going to get right to calls. 866-300-9298. And, of course, you're listening to Financial Issues Rapid Fire Friday. And keep your questions to the point, right? Get right to it, and or your comments, and we'll try to answer them as quickly as we can and move on. Okay, let's talk about a couple of things. First, U.S. Well, let me first start by the GDP number. We got the second look at the GDP. It is down. It is negative 0.7%. That is a 1% swing from where it was the first look. So it is now negative 0.7%. Of course, they were expecting something around, well, frankly, they were expecting a negative 0.3. Then they revised it early this week to 1%. I have been saying 1 to 1.2%. It's 0.7%. That is the second look. That is not the number for first quarter GDP. Right now, second quarter GDP looks like it's on track to be a 1% growth. So they better hope that doesn't happen or we're going to be in trouble for the year. But nonetheless, it could be negative because we are seeing corporations announce layoffs. Again, J.P. Morgan announced these 5,000 layoffs, other companies announcing layoffs. Why would that be? Well, I'll tell you, U.S. corporate profits for the first quarter of the year, that out also. U.S. corporate profits on average sink 5.9%. That's the biggest drop since 2008. Does that tell you anything? It's the biggest drop since 2008. In the first quarter of 2008, when we saw that drop, we know what followed. So U.S. corporate profits sink for the second quarter in a row, by the way. This is not the first quarter. This is the second quarter in a row. We see negative U.S. corporate profits, hence the layoffs that are being announced. So we'll continue to watch that. That's not going to bode well for the second quarter of the year. That is for certain. But that's one huge issue. Now, I didn't hear anybody talk about that this morning. I doubt that we will. I mean, it wasn't even mentioned on any of the financial networks that I was monitoring, but interesting stuff. But U.S., it shrinks. The U.S. economy shrinks 0.7% according to this. Originally, the government had said it was going to grow by 0.2%. That was the original call. Wall Street was expecting a gross domestic product to be marked down. We saw a 1% decline in GDP, and that was the revised forecast by most economists. Consumer spending, no change. No change to speak of in consumer spending. That is not good. That is the main engine of the U.S. Economic growth. That's not changing. Inventories obviously adding to GDP. Inventories add to GDP, they saw an increase, and by the way, a smaller increase than they had earlier anticipated. They have an increase of $95 billion. That is in lieu of $110 billion. Exports also fell. There were slight increase in imports. That was revised up. And the bigger trade deficit that we now have will subtract from GDP for the second quarter. So the trade deficit is going to participate in the second quarter, and that's what we have right now. Also, spending on structures from businesses and this would include, by the way, oil rigs, is down again dramatically as well. So things aren't looking real good. Most are forecasting GDP to be around 3% this year. Not too likely, according to the numbers that are out there. 3% is not good enough anyway. In the old way, they used to figure GDP for the last 50 years. 2.5% was the break-even point. Then they've added some stuff back in July of 2013. So I don't know what the real number is, but it's got to be more than 2.5%. So let's say it's 2.8%. Or maybe even 3%. So 3% growth means that we continue to go backwards, and that is based on no population growth because according to the BLS, the population hasn't grown in many, many years. We're still using 250 million as the number that all the statistical data is based on for population. The population is actually 307, so just off by a little bit, like 57 million. But nonetheless, that is beneficial for the numbers as they come out by the BLS, and then we have everybody else out there that's looking at these numbers, totally ignoring the fact that the BLS and the government is using skewed numbers, and then they start believing the numbers because they've ignored it for so long. They think it's actually a good number. Disturbing. U.S. oil producers are back in the black. Apparently, with oil prices being where they are, even with gas prices down, this is not a happy. You can bet on the fact that OPEC is not a happy camper right now. They're still in big trouble. They're continuing to ramp up production. They assume that at some point in time they're going to hurt the fracking side of the oil business so much that they're going to get market share again and probably anticipate getting $90 to $100 a barrel in short order. It isn't going to happen. They got to be really annoyed at Iraq, who is increasing to 800,000 barrels a day. That is a dramatic increase by Iraq. Their thoughts are, well, they can't afford to keep that up, so they're probably not going to, but that's got to help Saudi Arabia. Saudi Arabia is going to be in big trouble. I would suggest by the middle of next year, they're going to be in big trouble because they don't have enough money to support their infrastructure. They just don't. I mean, this is a country that's highly dependent upon oil. It's all they got. They don't have anything else. They got a little bit of tourism. That's about it. They got a lot of sand, but they haven't figured out what to do with it yet, and that's it. So I kind of like this, to tell you the truth. I'm not going to lie. I think it pleases me to see Saudi Arabia, that's held a gun to our head since the 1970s. It is coming home to roost. We can thank George Bush for that, by the way. Some of you, I'm sure, might want to thank President Obama. President Obama still hasn't reissued permits for the ones that are shut down from the BP oil spill. All these permits that are pumping now were issued by the Bush administration when gasoline was at $4.11 national average. And his goal was to drill, issued all these permits. Takes years for these permits to come to fruition. And this is what we have right now. So you can thank George Bush. Next time you see him, let's give him a high five. Thank him for the cheap gas prices throughout the summer. Greece sliding back into recession, according to the data. The data's pretty much confirmed they're back into recession. Interesting, Canadian GDP growth also down. Canada sees a drop in their first quarter GDP growth as well. I think they've dropped, I thought I had it here, I don't. I thought they dropped about think they dropped about 0.3% in negative territory. So Canada is suffering as well. That's probably got a lot to do with the oil industry, I'm sure, for Canada. India's GDP growth hits a 4-year high. It's expanded by 7.3%. By the end of March, 7.3%. The reason I bring that up is because according to the Financial Times, they believe that India is going to top China as the fastest growing or the fastest growing economy in Asia. And they believe that is going to happen by the end of this year. And that India, wait a minute, China, by 2017. 2017, that's what the World Bank expects. But some, according to the Financial Times, are saying it's going to be by the end of the year. The Financial Times is expecting that they are going to outpace China not until 2017 or the end of 2016. So India, that's going to do well for emerging market funds, obviously, if that continues. A lot of emerging market funds throughout India. Here's the big thing about that, and this is why I want to kind of tie it in to what I was just talking about with the oil. Look, I know we've got cheap oil, and oil is cheap. It is abundant. But I was talking about this a year and a half or so ago, or a year ago, when oil really started coming down. I said, look, the beauty of this, I wrote some articles on it. You can find them on my website, talking about what is happening with cheap oil is it is increasing the level of addicts on cheap oil. In other words, in the emerging market, these companies, these manufacturers in particular, that are startup kind of companies, even manufacturing that's already there, some American national companies that are looking to expand, it's making it cheaper and cheaper for them to expand through the cheap oil. The beauty of it, these new startup companies, as they began to gain market share, gain market share, which they're doing it because they're competitive, because of cheap oil. They begin to expand their business. As they expand their business, they become more and more dependent upon oil. And as they become more and more dependent upon oil, the idea that if you raise the price of the drug that it's going to go away, it isn't. The addiction is still going to be there, and the addiction is going to be stronger and more powerful than ever in some of these emerging markets that may start to develop into developing nations, not emerging markets anymore. And oil, once again, is going to be high. Look, they're not the emerging market. If you look at India now starting to outpace China, or getting close to outpacing China as the fastest growing economy in Asia, when you look at that, I got news for you. The last thing China's starting to come around, but India doesn't really care much about fossil fuel. It's not an issue of theirs. They're looking for cheap fuel. Will they certainly advance with some of these emerging markets with renewable fuel energies? I suspect they will, like China's doing. But the fact of the matter is, they're going to get there on the back of oil. Make no mistake about it. And that is going to maintain a certain level in the oil industry of pricing. Not to mention, oil companies probably going to do well even in the middle of very low gas prices and low oil prices. This is something we haven't seen in a long time. And because these low oil prices have been sustained, what Saudi Arabia doesn't realize is they've actually done a huge favor to American oil companies and refineries, in that it has forced their hand to become more efficient, more economically feasible, learning to streamline and consolidate some of the things they're doing. So they've actually done a huge favor to the oil industry, and their margins are still going to stay good. You're still going to have strong margins in the middle of this. It is not going to have a crippling effect. It's going to have a long-lasting, sustainable, positive effect on bottom lines of oil companies. So interesting. And we're starting to see that already. So again, low gasoline prices, low oil prices have proven to be good. Obviously, they're going to be good for refineries for some time as well. And we're going to start to see it trickle into the chemical industry, the Huntsman Chemicals, some of the other chemical companies that are on my list. You're going to start seeing them do better because, again, fossil fuel a key component to their manufacturing. It's Rapid Fire Friday. We are going to move on to phone calls since it's Friday, and we're going to get to the calls. Here's the deal. Keep your question to the point. We'll answer it. We'll move on to the next caller. You're listening to Financial Issues, American Family Radio Network. I'm Dan Celia. It's great to be here. We'll be right back.
You get the soil ready. You put the seeds in and then you water it.
How do you plant a garden?
I don't know. You pray that God will give you a good harvest. And you have to work it to get all the weeds away. And then God brings the plants.
Planting a garden takes planning, hard work, and God's blessing. So does creating a lasting legacy for the people and charities that mean the most to you. The AFA Foundation is here to help you sow the financial seeds God has blessed you with in order for them to blossom for generations to come. We do this by offering free consultation and assistance in the areas of charitable gift annuities, estate planning, will and trust planning, and bequests. To learn more, call 800-326-4543, extension 345. 800-326-4543, extension 345, or visit afafoundation.net.
Good morning. Welcome back to Financial Issues. I'm Dan Celia. It is Rapid Fire Friday. We try to get to as many calls as we can on Friday, and we're going to do that. 866-300-9298. Remember to keep trying. People drop, lose phone service. We finish up with the call, whatever. So keep trying. 866-300-9298. Let's start off this morning with Alice. Alice is calling us from Texas. Hi, Alice.
Hi. Well, my question, Dan, is related to something you've been saying. You've been saying set aside cash to have at home in case of financial problems like the bank closing, like dollar devaluation.
Mm-hmm.
Now, every month I set aside a little money for the property taxes.
Okay.
And I've been thinking, what happens if this financial event happens the month before my property taxes are due, or even the month my property taxes are due?
Yeah.
Will the government still, even if the banks are closed, ask for me to pay my property taxes? Will I pay with the devalued dollars? Will I have to pay with the devalued dollars? Will the amount of my property taxes change as a result of that?
Well, yes, they're going to still ask you to pay your taxes. You can count on that. It's going to be a difficult situation if it just so happens to be the time when the banks are in a 2 or 3 week shutdown mode, if things get that bad, because there's a whole lot of people that obviously aren't going to be able to pay, that escrow their taxes in financial institutions. So that's going to be a difficult situation for them one way or another. So obviously they're going to have an extension, some sort of extension to that. But nonetheless, the taxes aren't going to go away. They're still going to ask you for it. If we have a scenario where we've got a major crisis and the devaluation comes as a situation where it is purposely devalued in order to try to reset the currency and the values, if that happens, that's certainly a possibility. It's not necessarily the scenario I'm seeing this year, but if that were to happen, then of course everything is devalued, or it would defeat the purpose. They can't do it without everything being devalued. If the dollar devalues, the debt devalues, your salaries devalue, everything's going to devalue equally. So I would have to believe that would mean property taxes. That's why it's going to be such a difficult situation for the government to do. But at the same time, it may be the only way they can get debt to GDP debt to GDP percentages in line, and that's why it would happen. So yes, your taxes would be due, and what you would do in that case, you would have to pay your taxes. So your goal has to be to set aside even a little bit more, if you can, than you might set aside for your taxes, so that you have a little bit of extra so you can still pay your taxes. So that's going to have to be your goal, to set aside a little bit more if in case we have that. Listen, if we have a major financial crisis, if we have a major crisis in the markets, banks are going to shut down, not just because of the devaluation. Forget that. Even if they don't devalue, the banks could still shut down for a period of time. Because if it appears as though there's going to be a run for liquidity, in other words, there's going to be a run for cash, people are going to be withdrawing money in cash. They're going to want the greenback. They're going to want the cash. They're going to start withdrawing like they've been doing in Greece for the last 3 months. If that looks like that's going to happen or that starts to happen, then there's going to be a cooling off period. Banks are going to shut down for 2 to 3 weeks just to get everything settled back down again before they reopen, or they're going to start to reopen for small periods of time so that they can try to get their liquidity in order. Let me go to Paula. Paula calling us from Louisiana. Hey, Paula.
Hey, I was calling. I have about $430,000 in my 401k, and I have half of it that I put into money market. I was told that I should do that whenever the Dow Jones is over 18,000, and so I did. But then I was wondering, is money market really the best place for that money?
Well, the money market's
or should I move it into something else?
Yeah. Well, there isn't anything else. That's the real problem, Paula. I can't say that the money market part of that is the safest. I will say it's safer than anything else that you're offered there. Is it going to be bomb-proof? No, probably not. There could still be some issues with it, but we have no alternative but to do what is what seems to be the safest thing to do. And in your 401k, that is your only option. So you don't really have any other choice. Somebody might say, well, you got a bond option, or they're not options because they're not as safe as the money market account. So there's nothing is solid as far as safety goes. So what we have to do is we have to look for the safest or the safer of what we have offered to us alternative, and that's money market account. So I think you did the right thing, and you need to stay there through the end of the year. Thanks, Paula. Let me go to Sherry. Sherry calling us from Texas. Hey, Sherry.
Hi, Dan. Thanks for taking my call. I'll try to make this quick. I appreciate what you do, by the way. Thank you so much. This is a issue that my mother-in-law and father-in-law are having. They are both 85 years old. They took out a line of credit 15 years ago. I'm reading from her notes, by the way, to the bank. 180-month loan, $830 a month. The total payments would have paid out $174,000 with a balloon. Within that was a balloon note of $25,000 at the end of the 15 years. They have about 5 more years to pay on it. Mm-hmm. In 2014, January, the bank changed this mortgage to a 30-year, 360-month note where it would pay out a total of $299,000. She's been trying to talk to the bank. She's written letters. She's gone up and seen the bank manager. Her with an attorney who is not really acting as an attorney, but just a mediator today. They are walking into the bank, just walking in there today to try to get something done. What is the bank's responsibility on this? By the way, the bank cannot produce the original loan papers, but my mother-in-law has the original loan papers.
Well, if your mother-in-law has the original loan papers, thankfully, she has to have someone take a look at the provisions in the loan papers. I would suspect, you said this was 15 years ago. I would suspect that in 15 years ago, they're not going to have they have the rights to sell the loan, I'm sure, but they don't have rights, or the buyer of the loan doesn't have rights to change the provisions of the loan. So I don't think they can do that. Of course, can't find the original paperwork as a matter of convenience. But as long as your mother has the original paperwork and she is certain in there that they're unable to do that, and that's where she's going to need an attorney to take a look at it, make sure that is the case, then they can't do it. period. And they're going to know that, and they're going to fear for a lawsuit. The other thing that she needs to do, if she finds that out, she needs to contact her local congressional representative and let them know that. She also needs to contact the county representative at the state attorney general's office and let them know what's going on. And if she really wants to get to the bottom of it, she needs to copy everything that she's doing and sending and notifying everybody to the bank commission in Washington, D.C., the OCC. She needs to do that as well. So she needs to do all those things for certain. And I can almost guarantee you, if the original loan papers don't allow it, it's going to be reversed immediately, and any damages will be paid back to her. So, and I suspect that it will be. So, this is something that she's doing the right thing by going in there with a mediator. But I would probably take it a little bit further and make sure that they understand that she has the original paperwork, and the original paperwork is under scrutiny now by an attorney or whatever, or will be shortly. And you don't think they've acted in good faith, and she wants it reversed. So anyway, I think if you do that, I think you'll be fine. I think she should be all right. Let me know how you make out on that, because I'm curious about it. Let me go to Lisa. Lisa calling us from Virginia. Hi, Lisa.
Hey, Dan. So this might seem minuscule on the scale of things that you do, but I'm 38. I'm married. I have 4 kids. I work full time. I'm covering all bills. I don't have any savings or any retirement or anything like that. But I do have a couple of $100 right now that I want to try to do something with, because I don't have anything started, and I feel panicky, like I just need to get started, even if it's with a tiny bit. And I have no idea what to do or where to put it or anything.
Well, yeah, that's not minuscule at all. I mean, that's important issues. The first thing, Lisa, is that you really need to, before you start thinking too much about investing, you've got to think about saving. You've got to have some savings. The reason why you got to have some savings is because it's the savings that's going to help you stay on track when you start investing, and it's going to help you stay out of debt. So the savings is really, really important, so that if you have a situation, whether it be a medical bill that's not covered, whether it be a transmission in the car blow up, whatever it might be, that you've got adequate emergency savings to pay for that and take care of that. So that would be my first order of business for you, is to make sure that if you have a couple extra dollars saved and they're in the bank in a savings account, then they should stay there, and you should try to add to it on a regular basis. The key, though, as you start thinking about retirement is, I don't have a problem with you opening up a Roth IRA account. And I think that would be wise for you to do that. And you may want to do it at a mutual fund company where you can just put $10 a pay into this Roth IRA account on a regular basis. Anything over and above that, or anything, trying to split what you have in discretionary income. So say at the end of the month, you've got $40 left over, try to get $20 or $30 into your savings. Try to put $10 into that Roth IRA account. If you do that now, even at 38, I think you'll be fine, because what's going to happen is you're going to get the savings at a pretty good place, and then you'll be able to start putting that money that you were putting there over into the Roth IRA account. And I think that would make really good sense for you to do that. I would stay biblically responsible in any investing. So if you're using a mutual fund company, I have to tell you to go to Timothy, because it's the only one I recommend, timothyplan.com, and you can talk to them. But you need to do that if you want to stay biblically responsible, and you need to just start the discipline. That's what this is about. The discipline. $10 a month. It doesn't seem like much. It isn't much, but it's good enough to start creating the discipline of doing that on a regular basis. And that's what I'd like to see you do. Folks, we have 2 lines open on Rapid Fire Friday. And the board's been full for all week long. 866-300-9298. So if you were trying to get in, you'll get in right now. 866-300-9298. Let me go to Debbie. Debbie calling us from Louisiana. Hey, Debbie.
Good morning, Dan.
Good morning.
I'm going to get straight to the point.
Okay.
I was recently terminated from my job.
Okay.
I have an IRA from a previous job, and I have my 401k that is no longer being, invested in. So I want to roll both of these over into one lump sum into a traditional IRA.
Okay.
And we partnered with you. I've been looking at your asset allocations.
Mm-hmm.
I'm thinking 60% in a money market or CD, and the other in different Timothy, like the defensive strategy, the conservative growth fund, possibly some preferred stock utilities.
Mm-hmm.
So I'm wondering how that sounds to you.
I think that sounds fine. I think that sounds very good. And I think that's a good strategy. I would do that. You'll need to open that account at like a TD Ameritrade so that you can do everything. So in other words, you can do a CD if you want. You can do a money market account. You can do some preferred stocks, and you can do whatever Timothy funds you want to do through TD, and that would probably be your best bet. So you probably need to go there. I know there's some other brokerages there's one in particular, I can't think of the name of it. I know there's some others where you can do all that. But I think that sounds really good. I think that's a great strategy. I would do that. I would probably suggest to you at the end of this year or when the dust settles, after what we might see, Debbie, then I'm probably going to ask you and would tell you to get a little bit more aggressive. And maybe now that's the time to start moving out of the defensive strategies and the conservative growth and maybe move into the Israel fund and growth fund or something like that. So that would make more sense. But I think that's a great strategy. So I would do that. Thanks, Debbie. Let me go to. We only got a minute. Okay. Let me hold off so we don't have to cut anybody off. So hang in there. 866-300-9298 as we come up on the break, folks. Also, we had a great conference call last night. We did have some technical issues, but aside from that, those on the call, we had a few hundred people. It was a great call, and I sure appreciate all of you. It was a little rough for me. I don't do well at night. I go brain dead about 5 o'clock in the evening. But anyway, it was a good conference call. If you want to participate in those kinds of things, participate in some of the videos that we're going to have online, man, if you'd partner with us on the website, it would be a blessing. Partner with the ministry. It's only $85 a year. It doesn't sound like much to you, but it means a great deal to us here at Financial Issues. So check it out, financialissues.org. We'll be right back. Hi, this is Dan Celia from Financial Issues. Would you consider partnering with us in the ministry? Let me tell you what you'll get for a partnership with Financial Issues. You'll get access to my stock pick list that I put out every Monday. You'll also have access to your own asset allocation model. You'll get my email alert system that goes out on a weekly basis, sometimes twice or 3 times a week, that might alert you to something that's going on in the markets that could impact your portfolio, maybe a specific to sell a stock. By the way, everything I do is biblically responsible. When a stock, for some reason, takes a left turn, that company, and is no longer biblically responsible, I immediately issue an email alert telling you to sell it. You have access to our conference calls, our asset allocation model, and much more. Would you partner with us at financialissues.org? That's financialissues.org.
The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Good morning. Welcome back to Financial Issues. I'm Dan Celia. It's great to be here. 866-300-9298, and we are rapid firing today through the calls. So, excuse me. We'll get right to the question and answer, and we'll move on. Let me go to John. John's calling us from Texas. Hey, John.
Hey, Dan, how are you?
Good.
Hey, I'm 30 years old. I'm going to work for another 30 plus years, I figure. I've got $100,000 in an old 401k, and I'm moving it to an IRA, and I'm trying to determine whether I should go into a Roth IRA or a traditional IRA.
Well, ideally, John, Roth IRA would be wonderful. I think, especially at age 30 and continuing to contribute to that, I think that will serve you really well when you do retire. The downside to that, of course, is you've got to pay tax on $100,000, and that's not a good thing. So that's a little bit more of a difficult situation. But what you can do is you can roll over all of it into a traditional IRA at a place in which you want to roll it over to. And then at the same time you open that traditional IRA, open a Roth, and you could, move some of it to the Roth this year. You can move some of it next year and the year after that and such, and make your contributions, ongoing contributions to the Roth. And I think if you did a strategy, something like that, the burden of the taxes wouldn't be so bad, if you kind of wean it out of there. And I think that would really help you in the long run, and then just be committed to making all your contributions to the Roth. The other downside, John, is you must do pretty good, I would assume. So the downside might be, and this is something you might need to think about, is you're not going to get the tax benefits that you get from a traditional IRA, immediate tax benefits. Long term, the tax benefits are better, in my opinion. But you're not going to get that tax deduction for your contribution when you put it into your traditional IRA. Then obviously it would impact your taxes a little bit, but it might not be enough to make a whole lot of difference to you. But keep that in mind as well. So hopefully that helps. Thanks, John. Let me go to Lawrence. Lawrence calling us from Texas.
Hey, how you doing, sir?
Good.
Thanks for taking my call. All right, I'm gonna make mine. I have a collective of questions, and I'll make it real quick.
Okay.
My question falls in line with the other young lady who said she didn't have anything saved and she pays bills and different things like that. Well, I'm 37, and I'm kind of starting over. I don't have anything saved, but what I've started doing is putting $100 a week away in like a cushion account, and just for a rainy day. But then also I'm thinking, okay, when I get 65 or whatever, I'm trying to, thinking long term, but I want to buy another house. I was a homeowner, sold my home. I want to buy a house between now and by the time I turn 40. But my concern is I don't want to mortgage over into my 60s. And then also I want to know what avenue, to channel far as old age and like RA, is that the best way to go, or 401k? I just need some kind of direction to start.
Right.
At this age now, and so that's what I need to know.
Well, here's what you ought to do, Lawrence. You're doing a good job. You're putting that $100 a month away. I would continue to do that because your one of your primary focuses has to be to save for that down payment for that other house. So you need to do that. You need to be putting that money away. The other issue is that you're going to need you want to try to have as big a down payment as possible because you're going to want to get a 20-year mortgage. If you get a 20-year mortgage, then at least by the time you're 60, it's paid off. I think if you get a 20-year mortgage, you can have it paid off in about 14 years if you just pay one extra payment to principal a year, which is easy to do if you're paying half your mortgage payment every other week, every payday. Then you will have made an extra payment every year. And that dramatically reduces that 20-year mortgage. So I think you'll be in good shape in that regard, but you do need to save that down payment money. I hate to say that saving that down payment money, I hate to put that over a priority of a Roth IRA account, which is the kind of IRA account you ought to establish. But it kind of is a priority, and it is going to be important for your retirement to get to the point where by the time you're finished working, you no longer have a mortgage payment. And I think that's really critical So I want you to really save as much as you can. Now, having said all that, if you're putting $100 away right now, I would put, I know this doesn't sound like much, but I'll tell you the same thing I told the other lady, Lisa, that you ought to take $10 or $15 out of that 100 and put it over into a Roth IRA account that you start to get started anyway and get in the discipline of doing that. My hope would be that if this year you're doing 100, next year maybe you're doing 120. You know, maybe get a pay raise in January, and you're able to set aside a little bit more money. So I think you're on the right track. I think you're doing everything well, but you've got to continue to save the bulk of your money for the down payment on that home, and then put a little bit of something to get that discipline started for that Roth IRA account. So you're not doing nothing. You know, you're doing something. But I think by the time you're 40 and you buy your home, you're going to have a good 25 years to really contribute in a strong way to that Roth IRA account. I think you'll be okay. So that would be my recommendation to you, Lawrence. Great question. Thank you. Let me go to Chris in New Jersey. Hey, Chris.
Hey, how you doing, Dan? Thanks for taking my call.
Sure.
I wanted to know, when you said before about consumer spending being the backbone of the economy, is that a good thing? You know, what about trade? What about manufacturing? Those type of things, as opposed to consumer spending.
Yeah, that's a great question, Chris. It is not. It is not a good thing in the sense that I wish that so consumer spending is 71% of our economy. It would be wonderful if it were 50% of our economy, and the other 50% was exports and some trade kinds of issues, and it wasn't all some industrial kinds of things, and it wasn't all consumer spending. I mean, the ideal situation is that we would have a balanced economy. But the fact of the matter is we don't. We have a consumer economy. Now, the upside to a consumer-driven economy is it forces certain things in the economy, or it should force certain things. In fact, it hasn't, but force certain fiscal policy coming out of Washington that ought to be different than just printing money. Japan, a great example of that. Japan is the master of printing money. Their money printing far exceeds ours. They have about 200% debt to their GDP. But for them, it's a good thing because they're the opposite of our economy. The vast majority of their economy is based on exports. So when they trash their currency by printing more money, it actually helps them. But there's a report out just this morning that Japan is suffering because nobody's gotten pay raises for so long that there's no consumer spending. So they're suffering from kind of the same issue, no consumer spending, but their economy continues to plug along in this stagnation that it's been in for 15 years. And unfortunately, we here in America look at that saying, well, if they do it, we can do it. The difference is their printing money actually helps their economy, not weakens it. Ours weakens it. So yes, the ideal situation that we would turn that around. But in fact, we have seen our trade deficits getting larger instead of smaller. We had a run there early last year, about this time last year, we had a run where we saw the deficit starting to get in line a little bit, that our exports were picking up. Now, I suspect we're going to see our exports picking up again just as a result of the fact that if we continue to produce as much gasoline and we continue to export that gasoline, I talked about this yesterday, then I think we're going to start seeing that pick up a little bit. So, as a result of through some industrial kinds of things. So to answer your questions, is it a good thing? No. It is what we have, though. And I believe it is going to take us years of good, solid fiscal policy coming out of Washington and some changes in the corporate structures and incentivizing for us to begin to start creating that balance. It's going to take some time to get there. But in order for us to get there, we're going to need some leadership. And frankly, it's not there yet. I can't say I'm jumping up and down over any of the candidates that I've seen either, as far as leadership from an economic standpoint. So we're going to have to watch that closely. But you make a good point. It isn't necessarily an ideal situation, that is for sure. I certainly wish it weren't that wasn't the case. We'd probably be better off. Let me go to Caleb. Caleb calling us from Texas. Hey, Caleb.
Hi, Dan. Thank you for taking my call. I have a quick question. I have a rental property that my wife and I are planning to sell within maybe a year or two. We have an annual loss of about $4,000 and can only deduct about $1,000 in our taxes. We can afford to make additional payments to reduce our loss. Do you recommend making additional payments to the rental property, even though we're planning on selling it in the next year and a half or two?
No, I don't, Caleb. I think you could do something better with that money. I don't think that would be a good use of the money. I'd rather you keep that money now, save it, invest it, or save it looking for a different property. I think in the long run, in a year and a half, when you sell that house, you will have the money you were going to put in to the rental property to reduce the debt, and then some. So I think in the long run, I think you'll be better served by not doing that. I don't want to encourage anybody not to pay down their debt, and that's not a good thing. I don't want to discourage people from doing that. That's not my intent. I'm just looking at the reality of it, and the reality of it is you can continue to afford to pay for that rental property as it is now, and you still have income and so on and so forth that allows you to do that. And I'd rather see your discretionary income going into savings and other things as opposed to that property. So hopefully that helps you. That was a great question. Let me go to Robert from Arkansas. Hey, Robert. Robert?
Oh,
yes.
Can you hear me?
I sure can.
Good. How you doing, sir?
Good.
Two broad question. I'll start real quick here. I just got a traditional IRA because I can't get 401k through my place I'm leased on to because I own my own 18-wheeler. Now, I got a traditional IRA instead of a Roth because I need all the write-offs I can get. But I keep hearing you say invest in a Roth. Did I make a mistake there?
No, because if you need the write-off and that is benefiting you today on an annual basis, that's benefiting you, then no, I don't think you made a mistake at all. I think that's fine. The only thing I would say to you, since you're an independent, you're self-employed basically, right? So
yes, sir. Since
you're self-employed, the only thing I would suggest is that you change the traditional IRA to a traditional SEP, S-E-P IRA. It's not going to be a big deal to make that change. Everything's still the same. The only difference is with the SEP IRA, you're allowed to put in a lot more money. Now, you might not have that money to put in, but you may have a year that you do, or a year or two between now and the time you retire. And it's worth having it open so that if you get a windfall, maybe you get a bonus or something happens, you sell something or whatever, and you have an opportunity to now say, I could put $12,000 in my IRA. Well, you can't do that if you just have a regular old traditional IRA. You can only either put $5,500 or $6,500 if you're over 50. So the only suggestion I would make to you, Robert, is that you keep it up. That's fine. You're not making a mistake, but I would just change it to a SEP IRA so that you have the opportunity to increase the amount of money you put in there. Let me go to Dana real quick in Maryland. Hi, Dana.
Hi, Dan. Can you hear me?
Yes.
Okay, I have a question. Well, I have two questions. First of all, I've had a Roth IRA. It's a mutual fund, and it's about $9,000. And I've had it for about 8 years. And I'm really interested in doing something biblical with the IRA. Is it possible that I can take that out and put that in the Timothy Fund?
Absolutely. You just roll it over. Does it cost you anything, Dana? All you got to do is go to Timothy and open up the Roth IRA account, and then they'll help you transfer it, and you can transfer it over right into the Timothy. And I appreciate your heart in wanting to do that. I think that'll work. I think that'll really work well for you. And yeah, you ought to do that. I think that'll be great. Sorry, right up against the end of this hour. Folks, thank you for being with us. We're here every day. We're trying to help you be the best steward you can be with all that God has given you.